Welcome back to the Japan FinTech Observer. Get ready for a quick hit of the latest news in Japanese finance and fintech. We're diving into the headlines, breaking down the trends, and leaving you with the insights you need to stay ahead of the curve. Let's go.
In today's episode, we're tackling one of the biggest questions of our time. How do we fund the global transition to a low-carbon economy? It's a monumental task. And while we often focus on shiny new green projects, the reality is that the entire global economy, including heavy industry, needs to change. Nowhere is this challenge more apparent or more critical than in Asia. A new report from the Japan Public-Private Working Group, titled Scaling Inclusive Transition Finance in the ASEAN region, offers a pragmatic and powerful roadmap. Today, we'll break down its key ideas. First, let's set the scene. Why focus on Asia? The report highlights a unique set of circumstances. 1. This is a region of incredible economic growth. Populations are growing, industries are expanding, and with that comes a massive increase in energy demand. 2. Meeting this demand with renewable energy alone is for now incredibly difficult. Unlike many developed nations, countries in the ASEAN region are still building their energy infrastructure. And 3. A large part of their economy is based in manufacturing and other hard-to-abate sectors. Think steel, chemicals, and cement. These are the industries that power our world, but they are also incredibly energy-intensive. The result is a dilemma. These nations are committed to the Paris Agreement goals. They have their own climate targets, known as Nationally Determined Contributions, or NDCs, but they are starting from a very different place. The report points out that many coal-fired power plants in the region are relatively new. You can't just shut them down overnight without causing huge economic disruption and jeopardizing energy security. Achieving their climate goals will require, as the report puts it, the mobilization of enormous amounts of capital. We're talking trillions of dollars, and that money has to come from somewhere. This is where transition finance comes in. The idea is simple. It's funding for companies and projects that are on a path to decarbonize, even if they aren't pure green today. But here's the problem the report identifies. Most international models for transition finance were designed with European or North American markets in mind. They are often built around things like labeled transition bonds, which work well in mature capital markets. The reality in Asia, however, is that bank loans, not bonds, are the primary source of financing. Furthermore, these existing models often demand that a company has a perfect, fully formed, science-based transition strategy before it can get funding. For many Asian companies, especially small and medium-sized ones, that's a bar that's just too high right now. If we stick rigidly to this model, we risk creating what the report calls financial carbon leakage, a situation where capital only flows to the perfect companies, while the rest, the ones that desperately need investment to improve, are left behind. This doesn't slow down emissions, it just slows down progress. So, what's the solution? The report proposes a renewed, more flexible framework it calls the inclusive approach. This is the core of the document, and it's a brilliant piece of pragmatic thinking. It sees transition finance in two distinct but complementary layers. Layer 1 is for labeled financial instruments. This is the familiar world of transition bonds. For these, the rules should remain strict. Credibility is key to attract global institutional investors, and we must avoid any hint of greenwashing. These instruments are vital, but we must accept that they will only ever meet a fraction of Asia's total funding needs. Layer 2 is the inclusive approach. This is where the definition of transition finance is broadened to accelerate the flow of funds to where they are needed most. Under this approach, a project or company could be eligible for transition finance even if it doesn't have a perfect corporate strategy, as long as it meets other objective criteria. What kind of criteria? First, is the project aligned with the country's own national climate plan? If a government has identified a specific project as crucial for meeting its NDC targets, that project should be seen as a credible transition investment. This gives investors a clear, government-backed signal. Second, does the project use the best available technology to significantly improve the current situation? For example, Financing a highly efficient natural gas plant to replace an old polluting coal plant is a clear step forward. And third is the technology itself on a pre-approved list of transition technologies. The report suggests creating lists of technologies, from energy efficiency and grid modernization to CCS and hydrogen-ready infrastructure, that are recognized as contributing to decarbonization. Of course, this raises a crucial question. What about carbon lock-in? The risk that we might fund a new gas plant that will be emitting CO2 for the next 30 years. The inclusive approach addresses this head-on. It's not a free pass. It requires ongoing engagement and follow-up. Financiers must ensure that these projects have a clear and credible plan for the future. For that gas plant, for example, is it designed to co-fire with hydrogen or ammonia down the line? Can it be retrofitted with carbon capture technology? The financing is tied not just to the initial improvement, but to the long-term pathway. This inclusive approach shifts the focus from demanding perfection today to enabling progress tomorrow. It's about financing the transition of the real economy step by step. The report also emphasizes Japan's role in making this a reality. Through initiatives like the Asia Zero Emissions Community, or ASEC, Japan is already working with partner governments to create the policy frameworks, roadmaps, and project pipelines that give private investors the confidence they need. This is about creating a shared understanding. An understanding that the path to net zero will look different in different parts of the world. A rigid, one-size-fits-all approach won't work. We need international financial institutions and investors to recognize that judging a project based on the standards of its host country, not the funder's home country, is the only practical way forward. In the end, the report from Japan's Public-Private Working Group is a call for ambition rooted in realism. It argues that to decarbonize our world, we must transform our industries, and to do that, we must finance them. Not just the green ones, but the ones in transition. By embracing an inclusive approach, we can unlock the trillions of dollars needed to support Asia's journey to a sustainable future, ensuring that economic growth and climate action go hand in hand. It's a vision where progress, not perfection, is the goal, and where every step forward, no matter how small, is a step worth funding.